Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So how can I make money if I believe this dollar is going to continue to slide relative to the yen? Well, let's look at this spread. How about if I go out and buy the 101 calls and I sell the 97 calls? Well, the index is at 98 and change, so it's in between. So once again, this is an at-the-money spread. I can buy the 101s for 25 cents, so that's cheap insurance. I can sell the 97s at $2.15, which is a nice credit of $1.90. How big is this spread? It's 4 points, right? So my credit's 190. I know that's my max gain. Where does the max gain come at? Well, remember, it's a credit spread, so I want both options to expire worthless. In order for these options to both expire worthless, this index has to drop down below the lowest strike, in this case 97. So I got to lose about $1.85 on this index, which puts me down to where this red line is, right? I drew the red line in as my max gain line. Does it seem feasible that that thing could be down below that red line in 2 weeks? Well, sure. It was below it here, and in fact, it spent all of December, all of January, all of February, and half of November below that line. Seems very likely that that's possible. Did it happen? Truth is, it did. This would have been a good trade. You know why? Because I can, again, look back with perfect 20/20 hindsight, and I know that the dollar relative to the yen closed at 94.78 on the May expiration, which is about right there. So you can see it went all the way down to about this level, well below my max gain line of which is this red line, and this would have been a beautifully profitable trade. I would have made $1,900 on this trade. Pretty easy to structure these things, right? All right, one last example, and then we'll go into our summary. How about this, dollar versus the Australian dollar? I'm expecting downside movement based on this chart because it looks like we've just fallen through a downside support. The support is the green line. Why did I draw it there? Because look, right here, the dollar bounced off of it. Right here, it bounced off of it after 2 days in a row. Here it did, I don't know what it did here, kind of monkeying around with it. And then finally right here, it falls through it. It hadn't been through it since at least, looks to me like it could have, the earliest time it could have been through this would have been way back in early December, or no, early October. And here it is May, and for the first time we're falling below a level that we set way back in October, many months ago. And in fact, it looks like a pretty solid fall through. So I want to take a bearish position here. I go out and buy 139 calls for 65 cents. Those are cheap. Sell 134 calls for 235. You can see that the index is right between the two, 134.93, but it's actually a lot closer to the short side. So this is at the money, but it's almost out of the money. This trade can be done at a net credit of $1.70. That's my max gain. That's my credit received. Where does that occur? At below the red line. Remember, I'm bearish. So I drew in my max gain line, which is if both of these expire worthless, which means it has to be below 134. So I start out at 134.93. In order to hit my max gain on this trade, it only has to go to 134. I only need to lose 93 cents in 2 weeks. Seems very simple, doesn't it? Where's my max loss? Well, if they both expire in the money, which would be way up above 139, which is up in this chain, up in this area. Is that possible? Yeah, it sure could. Break even is 135.70, which is the yellow line. This is an example where this index does not have to move. It can stay exactly where it's at, and I'll be profitable. If my break even line is above my current price, and in this case, this is what I would call a slightly bearish trade. This is one where I would say I'm slightly bearish or even neutral. If the break even is above the current price and I'm bearish, then this thing can stay exactly where it's at expiration, and I'll be below my break-even level. My break-even is at 135.70. Right now I'm at 134.93. So all I have to do is not, I don't need to be bearish. I just need to have not bullish. It just has to not move up in order for me to make money. And did I make money on this one? You bet. This would have been a great trade. Once again, I have perfect 20/20 hindsight. I can look back and I know that on 5/22, which was the May expiration, this index was all the way down at 127.75. So this thing got pounded in 2 weeks. This thing dropped from almost 135 all the way down to 127 and change. So I was way below my break-even price and way below my max gain. My max gain occurs below 134. We got all the way down to 127 before we expired. This trade would have made a nice $1,700 profit, max gain. You had $3,300 at risk, but you had $1,700 at profit, and you would have made it on this trade. So this would have been a beautiful trade had you taken it. All right, let me summarize. We're getting short on time. Here's the thing you need to keep in mind about credit spreads. Credit spreads have lower risk than naked options, as I showed you earlier. If you are wrong, and you're going to be wrong, there's no getting around it. At some point in time, you're going to be wrong. You can get just clobbered on naked trades. With a spread, you always got that max loss, so you don't have to worry about it. Typically, your credit spread is going to have a much lower margin requirement than naked options. Because that risk is so much higher on nakeds, your broker is going to charge you a pretty substantial risk risk margin in order to put that trade on. And your maximum loss is going to typically be equal to the amount of the margin requirement on a credit spread. Since we know what the credit spread requirement is, or since we can calculate the maximum loss on a credit spread, that's the amount of the margin. And that's how much you have to put up. That's almost always going to be a lot less than your nakeds. And finally, some brokers set option approval levels based on the risk and the type of trade. Schwab's a good example. We will approve you for spreads with less experience and lower financials than we'll approve you to trade naked. So it makes it a little bit easier to do. What are the disadvantages? Well, as we covered, you're always going to have a limited profit potential. So if you're extremely bullish or extremely bearish, it may not be the best trade to do. If things go really in your direction, I mean, the last example is a good one, right? Had I been naked on that one, I would have made a lot more money than if I would have put the spread on. But I typically don't want to take that risk. Your profit potential is always going to be reduced by the amount of money that you spend on the credit. Because you got two different options here as opposed to a naked, you're typically going to have a little bit higher commission costs. Not a lot. Commissions are pretty cheap these days, but it always costs more to do two legs than it does to do one. And then the final disadvantage here is that a spread order is typically not eligible for a price improvement through intermarket linkage. Now, I think that's something that actually may be changing down the road here a few months, but right at the moment, if you put a spread on and there's a better price on another exchange, you can't get that price. But you know what? On the examples we did today, we're talking about an index that trades only on the ISE, so that's completely an irrelevant issue. It doesn't matter. If you're trading an equity spread, then it's an issue. But in this case, since the ISE is the only one that trades these indexes, you're not going to find a better price anywhere, so it doesn't really matter. And that's the summary. And from here, we'll go ahead and move into questions. I spoke a little longer than I wanted to, but we got a good 5 minutes. If there's a lot of questions that come in, I'll be happy to stay on here for maybe an extra 5 or 10, and we'll try to answer as many as we can. So, Steve, if you want to step in here, we can both hit these questions, or I'll do them either way.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.